Hello everyone, going to do a quick real estate market update for the first quarter of 2023. The main theme of this update is a roller coaster because as you're going to see, we've got lots of things moving up and we've got lots of things moving down. So we're going to try and bring them all together and give you a perspective of where things are at and where they may be headed. So some of the things that are continuing to move, we've got home sales down, inventory down, prices down, GDP down, mortgage rates up, cost of living up, and population up, all of which we're going to briefly cover. But let's start with the home sales. So you can see in the first quarter, home sales this is across the Greater Toronto Area, are considerably down, likely just over 2,000 unit sales in January. This, of course, compared to all these different color lines, which correspond to the relevant year on this corner, or these years right here. So it kind of looks like more of the average in around the, I don't know, 3,300 unit sales per month in January, and we are ways off that. So unit sales across the GTA, including Barrie and Simcoe County, are down in relation to previous years. So what about prices? So this is the home price index. This is for Barrie. What the home price index is it match. It tracks prices over time. So this starts in 2005. That's the baseline year. But you can see if we were to overlay a line like this, we're all fine and dandy, appreciating as normal, and then in 2016 things kind of changed and we started to see a rapid increase in prices. In 2017 they kind of came down, and if you had purchased in this period, it took quite some time to get back to those same levels at which you perhaps purchased in around March and April 2017. But fast forward into the past 2 or 3 years, I guess, and you can see this rapid increase in prices followed by the decline that we've recently experienced. So just a little bit of a closer look. This originates in 2019, just to give you a better idea of what we've seen over the past, well, really 3 years. So if we were to show you where COVID started, that's where COVID started. So up until COVID, the market actually was starting to increase. Inventory was down and prices were going, but then they dropped interest rates, and that's where we saw this, well, it was no man's land, and then all of a sudden, boom, it was like fuel to the fire. And we saw prices considerably increase, and then obviously came all the way up and peaked in February of 2022, and since then we've seen a pretty steady decline of prices. So based off the home price index from January 2022, and remember I said the peak was actually February. So once February numbers are in, I think it's likely that we'll see this number be even larger. But as of January to January 2023, the index is representing a nearly 18% decline in prices. So one of the contributing factors of why I think at least that we're not seeing prices go even further is because of inventory levels, and inventory levels continue to be down, as you can see with the arrow here in our theme. So they were way down during this period where interest rates were down and on that trend line of prices going up. So just to give you some perspective here, so during this range, I think one of my numbers that I had recorded during that time was 3 days. And what 3 days means is if there was no more active listings to come on the market, but the market continued to sell based off of the current average unit sales within a month, then it would have taken 3 days to sell all of the active listings in around this late 2021 period. So fast forward to now, and we're in around 1.5 months, which you can say is a large increase off of the lows of this. This was historic lows, but this is still very, very, very low. And this is saying that within a month and a half, all of the listings would be sold. So this number really should be up in around 4 and 5 months. This is considered a balanced market, healthy market. So where it is now, it's still very much a seller's market, and this is really keeping prices where they're at right now. So we're going to have to see considerable more inventory And what unit sales are down. So if we start to see more inventory come on, there's a chance that this line could slip up. And then if it continues to get up into this period, or sorry, not this period, but at these levels, we could see prices come down a little bit more. But as it stands now, with unit sales down and not too many new listings coming on, even till this date, which we're in February, it's likely we're going to see prices stick where they are, if not possibly even increase, which we have actually seen off with the January numbers. We've increased in median price off of December and November prices. So one of the reasons why prices kind of shot out, and also reason why inflation's where it's at, is the growth of the money supply in Canada. So I thought this chart was kind of interesting when I came across it, but this goes back to 1980, and it just shows the 3-month change in the growth of the money supply in Canada. So you can see during that time when we were injecting a lot of stimulus into the economy, the 3-month change was the highest on record, at least based off this chart. But right now we've got the lowest on record. So we've really dropped back in terms of adding money supply. And this is also taking into account the 3-month change. So we're coming off a high, which is going to tell us that it's down, but at least it's the money supply is starting to come down because of our inflation prices. But then if we were to track this back to 1968, this is the actual money supply in Canada. And one thing that I thought was quite interesting, well, first you can see how dramatic the increase was over the past, well, this was the financial crisis really, and they started to really inject some stimulus, and then how much stimulus that was injected when COVID came, which is right and around this way. So we kind of were on a sharp increase, and then boom. But what I thought was interesting is if we put that sales price, see if you remember back to that other chart, it was kind of like this. It was just above the sale prices, and then we were way down. But with the money supply similar to this, you can see how inflated we are, and that's just a sign and another reason why we're less likely to see prices come down much more than where they're at now, just given what's transpired over the past 10 years. So on that note, if we look at CPI and the reason why all this stuff has been going the way it has been, but our CPI is still up. We're currently at 5.9%, and that actually just came out today. But this is an index, and it's showing from 2019 the growth of the consumer price index. So in around this point was probably levels where we should have been, and then you can just see the significant increase once we started to inject all that money supply that I just showed you. The one positive note is this is month over month CPI calculation. So where the other one is doing year over year, so that's why we continue to see these trends. So on those trends, we were seeing month over month increases of 1.5%. So that was on the increases going up. So this was, CPI is at 2, 3, 4, 6, 8. And luckily now we're starting to see month over month the annual change dramatically shrink, and we're more or less just trending sideways. So it's going to take about a year's worth probably to get through and to start to see these inflation numbers get back down to where the Bank of Canada wants them to be, which is their target of 2%. So what's the Bank of Canada done? I'm sure everybody's seen this, but this is the increases that they've done, and it's very, very, very significant to date. So we're sitting at 4.5% in terms of the overnight rate. It's been said that their neutral rate lies in between the 2 and 3% range. So the neutral rate is the range where rates don't necessarily stimulate and they also don't restrict growth. So we're still quite a bit above that neutral rate. And it's likely they're going to pause until they can see what the status of all these increases does to the economy. They're hoping it's going to cool and slow demand and bring inflation back down, which it's starting to indicate that it's doing that as of the current reading of the CPI that we just touched on. But it's likely that we're going to try to see them get back into this neutral range if they can. One of the things that I'm sure you all look at and but it's the 5-year government bond yield. So this is a really good leading indicator of what the Bank of Canada is going to do. It also really shows you what 5-year fixed rate mortgage rates are doing. So you can see that it really dropped, which was good, because I think they were starting to even price in, when is the Bank of Canada going to drop rates? And then now it's going back up because they've changed course and said that they're going to hold firm for some time. But if we go on here and we overlay the 5-year bond rate with the mortgage rates, I just wanted to show you how they kind of mirror each other. So if the bond yield starts to drop, shortly thereafter we can see mortgage rates start to drop. So in this case, they really came down, and then boom, they came down. So they always kind of follow. But where we're at now, we've got mortgage rates way up here, and we've got bond rates starting to trend down. So I think they actually are coming back up a little bit as of 2023. So we're likely in around this range here, but still quite a ways off where mortgage rates are. So it's likely, maybe not in the short term in spring, but maybe thereafter we might start to see a lot of these fixed rate mortgages start to really kind of come back down. So where are our mortgage rates right now? Mortgage rates, we've got fixed probably around the 5% range, give or take. It's going to be different for everybody. And then your variable, which is made off of the prime rate, which is closer rated to the Bank of Canada overnight rate, is around 5.5. So if you're on a variable right now, it's probably going to stay that way probably for most of 2023. And if you're on a fixed, well, you're locked in anyways. But if you're looking to go into a renewal, it's interesting to just look at so this is the origination. So that all of the new mortgages that are going out, this is what each one is during those times. So when variable was at 1.45% and fixed was quite inflated relative to that, we had everybody going into variable. So we had over 50% of the mortgages from this period here until, I guess, just into 2022 were all variable rates. And now, of course, we know where variable rates are. So you went into a variable at less than 2%, and now you're well over 5%. So now we can see mostly people are not getting into variable, but the leading now is shorter terms of fixed terms of less than 3 years. So just over, well, I guess maybe 36% are choosing to do that. And then we've got our fixed down here. But for the longest time, you can see a lot of people were getting into the fixed rates. But with these rates being elevated, it's really increased our mortgage payments. So this is an index, and it takes the average price of a home, again, using that home price index, which is released by CREA, and that's the Canadian Real Estate Association. This takes into account putting 20% down and amortizing it for 30 years on a 5-year mortgage rate, the current mortgage rate of when you're doing this. So if we go back to even the low, which is probably in around January 2021, the average mortgage rate was around $1,700 a month. And fast forward not even 2 years, and we've nearly doubled, likely closer to $3,200 a month. So that's really hitting, well, the CPI, and it's increased that and just put a lot of strain on household spending. I thought it'd be interesting to do a scenario of a property that recently sold. This is a duplex in Barrie. It's on Bayfield Street. I think they actually got a pretty good price to where the market's at. But let's look and see if you were to buy this property at $785 and do a current I think I used 4.9% for a current interest rate, which is likely actually kind of low. But with 20% down, let's see what your cash flow would be if we're doing predicting that you're going to rent out the top level and rent out the lower level. So this is vacant. So this is likely what this person is going to do. They rent out the top and rent out the bottom. But where is cash flow? So let's take a peek here. So purchase price $785. So again, 20% down. So there's your mortgage amount amortized for 30 years. There's our interest rate. So I've got our income here at 41 for the year. These are expenses. So I've got everything in there from taxes, insurance, utilities, all that stuff to give us a net operating income of just shy of 29K. So the total cash needed in this case with the 20% down, about $171,000. but your monthly cash flow is nearly minus 900 per month, which is going to bring you close to minus 11,000 for the year. So clearly that's not going to work for most people. So how much money would you have to put down to actually break even? So if we do this on this case, so you'd have to put 45% down, or over 353,000 down. And on that notion, you're going to have about $137 of cash flow per month. So we went from, what was it, 100, I just, I guess it was I think it was 150,000 that you would need to 300 and almost 70,000. So break-even points are still a ways off, and prices are still slightly inflated, and that's with interest rates. So a couple last things I wanted to get into. These are some policy measures that we could maybe see changed here in 2023. This is just from some of the different publications I read. And so we've got this. This is probably the most significant one that will put basically what it's going to do is increase the requirements for investors. So if you're going to try and claim the property income is this, they're going to require more capital down for some of these investor non-occupied purchases, which based off the previous slide is probably the only way you're going to be able to come close to a cash flow situation anyways, but that's probably the most so when they're going to do that, I'm not too sure. But if you are looking for investment property, there are actually properties that have been listed for considerable time on market that you can go in and you can negotiate, which is nice. So even though the inventory is down, it's different from the previous market. So there are properties that are sitting there for some time that can go in. You can go in with a lower offer, perhaps something that does work financially, and possibly you can get that. So it might be something to look at if you're looking to make an investment purchase, because if they do this, then it may restrict some of the properties you're able to buy just due to how much capital they may require. And this will differ based on each individual lender. But a couple last things I wanted to get into. So this is the Organization for Economic Cooperation and Development. So they do this leading indicators chart for all different countries, Canada being one of them. And it really does a good job of predicting where GDP is. So if we were to overlay this leading indicators index on top of Canada's GDP, you can see how much, how close it mirrors each other. So these two big dips there where we saw the leading indicators drop, this is the financial crisis in 2009, and this is the onset of COVID. And both times we saw a GDP dip. But you can see the latest dip, and this is kind of the magnitude of it as well. Not quite where we're at here yet, but we're still on the way down, but we've got our GDP up here. So what is this telling us? I think it's telling us that our GDP is looking most likely to decline, which is obviously signaling in many fashions a recession around the corner. That'll be tightening of the labor markets, and just overall a little bit more stagnant of an economy, a cooled economy, which is what the bank is trying to do to bring inflation down. But the interesting thing is once we get to that point, when do they then look at it from a stimulus perspective? So the other thing, so we've got population growth way up. So you can see this goes back to 2000, and this is the year-over-year population growth in Canada. And you can see COVID was way down, and so you could say, part of this is probably some of the applications that had to get processed due to the significant drop here. But I mean, we are way up here, and I would say the majority of this population growth are those coming and moving into the GTA, which is going to put additional stress on both our rental and resale markets. Which again is another reason why I think we'll see a little bit of stability in the prices, because this is going to put further demand into the market and maybe increase some of those unit sales that we saw, but more than anything keep that months of inventory stat low, which is going to keep prices flat, if not maybe even increasing, which is interesting. So to sum it all up, where do we go from here? I think it's my perspective that we're likely to see prices trend horizontal. I don't think we're going to see any sharp increase. I don't think we're going to see much of a decrease either. It's really going to be based off of the inventory levels. Should we see more inventory? I think so. A lot of people I feel have been on the fence. Should we list? Should we buy? Kind of waiting to see where the market goes. For the good portion of 2022, it was a declining market, and many just didn't want to get into that kind of a situation. But we've kind of found stability, and if not the floor of where prices are likely to be, which I think may prompt some to get into the market come the spring. So if we see more inventory, it'll be interesting to see where this goes. But all that being said, I don't think we're going to see massive increase or massive decrease. If we see one way or the other, it'll be minimal, with maybe a few percent either which way. So it's kind of a safe time to start getting back into the market, as these crazy fluctuations have likely been left behind us. And if a recession is around the corner, the Bank of Canada's likely next decision in terms of rates, so they have their predetermined rates decision set up for the year already. It's likely they're going to hold where they are. So what I mean by 2024 is when they're going to move it from where it's at now. I think they're putting it a pause on, which is going to mean we're going to stay the status quo until they maybe see the need to stimulate, and that is possibly going to be as a result of a recession, and also kind of going back to that neutral rate thing that we discussed, where they'd like to see that neutral rate come into the rate and the range to which it's not going to stimulate and it's not going to retract either. So and again, we're at 4.5, and the neutral rate is probably around 2.5. So they've got some likely, I think more than anything, what I'm trying to say is the next likely decision is not an increase, but probably a decrease. It just when, nobody really knows. So that's it for now. Hopefully you got a little bit of value at that. If you're looking to do anything, reach out. We can run the numbers and go from there. So until the next time, thanks for watching. Take care.